Okay? Real quick, I'll start this one right before lunch. We got like 5 minutes before we break. And let me get into this one. Involving children in the farming operation. How many of you here have kids that have an interest in, or maybe already are, in being involved or are involved in the farming operation? So many of you do. Okay, so we're talking people here that want to transition to the next generation. How do you do this? This is a major issue. I've dealt with some incredibly complex factual scenarios. When I first started out practicing, I was in North Platte, Nebraska over 20 years ago. One of the first ones I had to deal with was a couple that had 16 kids. 16! And from the Sandhills in Nebraska. I mean, it's pretty skinny in the Sandhills. There's not much to do, which probably explains the size of the family. But I mean, it's like herding cats. To do an estate plan or a business plan to satisfy all these interests and get this thing coordinated and transition from one generation to the next. And you got spouses with these kids, and you got grandkids, and so anybody here have 16 kids? Man, oh man. And that's just with one wife. Okay, child coming into the business. One way to do it is over the long term acquisition with supplemental off-farm income. This is becoming, you see this more and more often. Slowly, the kid over time buys in. Maybe they're buying stock interests in the business, or maybe they're actually buying assets, buying land. But at the same time, they're supplementing what they're doing by working off-farm. They've got off-farm income. You see that fairly common. So they do establish their own farm business. They gradually acquire farm assets, never really farming full-time, especially while the parents are around, because of that off-farm income. So that's one way that they can get a toehold in the business. Another one is they couple it with that off-farm income with a rental arrangement. So the parents start leasing ground, leasing assets to the kids. Kids are farming, they're also working off-farm, and they gradually acquire farm assets until they're able to farm full-time. Maybe always have that supplemental off-farm income. Didn't used to see that, do see that more common today than in the past with that supplemental off-farm income. But it's a gradual transition into the business. It's not an abrupt shift at the death of the parents. Sharing of labor and capital. Maybe the parents loan machinery to a child so the child can rent or own land over time. There might be a sharing of machinery and labor while operating separate businesses. This is where you get into joint machinery purchases. See this a lot to help broker the cost of that machinery. It is incredibly expensive. New machinery is expensive, so they split the cost between them. They're splitting the tax deductions between them, doing some unique tax issues with respect to machinery purchases. But you've got some issues that come up here. You don't want to get into a partnership situation typically, a de facto partnership. Part of this discussion I had Tuesday in the bankruptcy lawyer's office in Cedar Rapids was a de facto partnership that just exploded with liability issues. They never wrote anything down. And you run into some issues as to whether an arrangement like this, joint machinery purchases, sharing of labor and capital, are you really in a partnership? That is an issue that'll come up if somebody makes a claim against the business, if there's some type of liability event. The kid may not have the deep pocket, but the parent might have the deep pocket, and the parent's business might have the deep pocket. Creditor is going to try to reach that. And when you get into a partnership, if a court would say that you're in a partnership, then you've got joint and several liability all over the place, and it's a mess. Go after the partnership assets, then they can go after the individual partner's assets. So, and then you get issues. What if a partner dies? Who gets that deceased partner's share? And that may actually go to a surviving spouse rather than back to the parents. Surviving spouse of the kid, which is an in-law. You got some issues there. So you got to be careful on this sharing of labor and capital as one transition approach to estate planning and succession planning. Those are some problems that can come up. Child could use, rent, or purchase farm assets from the parents and start a farming operations. Tends to work well if the parents are retired age. Parent could become an employee, but that also almost always never works well. I'm not going to be an employee of my kid. No. It's just, there's something wrong with that. But if the parents are ready to transition into retirement, then that approach can work fairly well, where the child uses and rents and buys farming assets and starts the farming operation. These are just some options for transitional planning. Joint operations, maybe the parents and the kids do get into business together. So we formalize an arrangement, some type of farming arrangement, whether that's a partnership, an LLC, or a corporate form of business. And that actually, to put some formality to it, that's the way you want to do it if the parents are not ready to transition to retirement, want to keep in the business. So you actually get into an entity and you got the kids as maybe minority shareholders in the business, but they've got business ownership along with the parents. Might have more than one entity. You might have an entity for the land, not a C Corp, but some other type of entity for the land, then a different entity for the operational assets. And the land might be rented from the parents individually if it's not in an entity, or if it is, you would rent it from the parents' entity so that the kids can farm it. So what's transitioning here is parents have ownership of one entity in a multiple entity situation, which is receiving rent. So it's passive income to the parents. You got to watch the passive tax, but it's not SE income. And that's typically what the parents want to retire to, is some sort of passive income, not subject to self-employment tax. Now you got to watch the additional 3.8 now, but the parents would receive the rent and the kids have the assets with which they can farm. So that might also be a mechanism for equitable treatment of the off-farm heirs if the off-farm heirs own the landholding entity with the parents that's receiving rent. We're getting passive, non-control interests into the hands of the off-farm heirs, and that keeps them out of the decision-making on the operational entity, which is in the on-farm heirs' control. So we're trying to work gradually a separation of those interests over time. Okay? And benefit the kids equally, which is typically an objective of the parents. Okay? The off-farm kids, what do they want? They want dollars. The on-farm kids want control. And so what we're trying to do is equalize the value of those interests, even though they're totally different interests. So that's treating the kids fairly, but with different types of assets. Okay. So the summary of the basic options: the child could use, rent, buy farming assets from the parents, start their own operation, rent or buy machinery, rent or buy breeding stock, rent the land, buy the neighbor's land, maybe not the parents' land, maybe some gifts that are in there depending on the prices at which we set things, so there could be what we'd call some hidden gifts. Okay, let's start back in on things this afternoon. And we're going to start with some scenarios here, some case examples. And these are based off of situations that I've had to deal with over the years, and just kind of collecting these. People that I've worked with, either individual clients when I was in full-time private practice, or those that I've worked with over the years. So over the past 20-some years, I think these kind of summarize many of the issues that we see repeated over and over. And if you have input on these, feel free to speak up. But let's say that, let's start out simply with case example number one. This is a farming family that has on-farm heirs. Many of you indicated that you do have on-farm heirs. And it was critical for them. The issues were just simply recognizing when it was time to bring in the next generation into the operation. And there are some other aspects with respect to that, but I think that's going to be the focus of what you've got to look at. What's the timing issue? When is it critical, at what point in time, to bring the next generation into the operation? Again, that depends on the facts that you're given. Every situation is different. Financial situation, debt situation, ages of kids, all up and down. So whatever structure you choose, you want to maintain flexibility. So flexibility is absolutely critical with respect to much of estate planning, much of business planning, much of succession planning. That's a big issue, okay? So trying to recognize the right time to bring the next generation into the operation. Number two, what if you got a small operation and it's just time to sell out? You really don't have heirs to take over the operation. In that situation, the business just simply ends on the parent's retirement. The child moves to a non-farm career. Now, many of you may have that situation, but when that situation comes up, the business just simply ends when the parents retire and they sell off the assets and they use the sale of proceeds to retire on. And then you don't worry about the division between the farm and the off-farm heirs, the type of assets, the control issues, the income issues. That's just, that operation is done. It may continue to be a farming operation, but in some other family's hands. Third situation, you've got a small operation, and this one that transitioned to the next generation by means of a family agreement. This one was kind of unique, but there was actually a contract that was entered into amongst the family members. It was a family agreement. There was one on-farm heir. They had a family meeting that turned out to be very successful. And there, the off-farm heirs agreed, get this, to a reduced inheritance in light of being named beneficiaries of life insurance policies. This is really unique, and granted, not every family is going to be able to pull this one off, but this family did. You had on-farm heirs, you had off-farm heirs, and the off-farm heirs said, you know, we really would like to see this continue in the family, and we'd like to see our siblings here that are interested in running this operation be able to do so. And in order to help them along, we will agree to take less when mom and dad die. Isn't that nice? That's really unique. And they actually stuck to it after the parents died. You know, a lot of times you'll have the kids saying one thing and the parents thinking one thing's going to happen while they're around, but then upon the death of the second of the parents, the last of the parents to die, then the kids suddenly don't see eye to eye anymore. I've seen that repeat itself over and over, but that didn't happen in this situation. They said, we'll take less so that our on-farm sibling can get more. We'll be named beneficiaries of life insurance policies. That still didn't even things out. But then we went one step further. This was when I was in private practice, and I still was apprehensive about this. I'm one of 6 kids, so I kind of have an idea that not everybody's probably going to see the same way. You know, I'm the youngest of 6 with a 25-year age spread, okay, and 12 years between number 5 and me. Okay, and I've said many times 5 mistakes until they finally got things right. So you don't necessarily see eye to eye. Yes, and I have nieces older than me too, so go figure that one out. One of which we were in the same grade all the way through school. Try explaining that to, we were cousins all the way through school. That's just how we played that. That's how we referred to each other. But I insisted, I said, you know, okay, I really appreciate you guys and I think you guys can pull it off, but let's create another document. Let's call this a shared appreciation agreement. I want you guys to enter into another agreement. I want you to think about this here in case your family is thinking about doing this. Maybe your family can pull this off. But my fear was that if we leave all the farm assets to one kid and the other heirs agree to take lesser value in the non-farm assets, what if those farm assets, that land in particular, for some reason that we're not seeing at this point in time, escalates heavily in value? That may change the mindset of that kid, and he may now suddenly view it as an investment asset and he'll cash it in. And then there, you've got the rest of the family members that are left holding the bag, and I just saw that as potential for abuse, and I told him, I said, now I'm not doing this because I'm not saying I don't trust him, but you're all the clients here, and I've got to look out for all of your interests. So let's say that if the land values go up or appreciate substantially in value and he'd like to sell, I'm not going to say that he can't sell. In fact, we can't prevent him from selling the property. We can't put a bar on what's called alienation of that asset. But if he does sell out, that any appreciation in farm value beyond where we're at right now is going to get shared equally amongst all of you. So that does two things. If he does sell out to experience that enhanced value, he shares it with everybody else. And it also minimizes the likelihood that he would sell. And everybody was comfortable with that. That operation to this day continues in place. That one was successful. Okay? So just another idea. I would call that a shared appreciation agreement. And you can do this, but I would just suggest maybe put something in place where, you know, if one person's going to benefit from this, let's share that appreciation and value. Yes? No, there was no time limit on that. Yeah.
If his heirs sell out?
If his heirs wanted to do it, that shared appreciation was still there. They all agreed to that. Okay? If there's going to be a sale, at that point in time, we're all going to share the appreciation from the value as of right now out into the future. And that agreement is still in place. Okay?
And money from the life insurance policy could appreciate too.
It could appreciate also, yeah. But that's up to what the off-farm heirs do with it. They took a deep, I wouldn't call it a discount, but they agreed to get substantially less as beneficiaries of the life insurance policy than the kid that got the farmland did. If they were equal, then we got more of your issue there, but this was not equal. They were getting a lot less, just to help the on-farm sibling go.
On the opposite side, I was talking to someone that I've seen where the off-farm ones get a lot of the financial assets, and the other one takes the land, and they're like land poor. They don't have as much. A lot of times they don't have the money or the liquidity to do the farming because they didn't get the other end.
Yeah, the liquidity issue is a big issue too. Yeah, you can leave them the land, but that's all they've got. And so then they don't have the liquid assets to assist in the farming operation. That's part of estate and business planning too, and successful transition planning. It's more than just the real estate that's involved. You've got to be able to finance this thing. You've got to be able to cash flow it, particularly in the early years. If it's an abrupt transition, that's particularly the case. Yes, good. Example 4, larger farm that has both on-farm and off-farm heirs. So you got several issues here. How you transfer management to the on-farm heirs, how you equitably treat the off-farm heirs. What if there's an untimely death? What plan is in place if you've got a parent that dies untimely or the selected on-farm successor heir dies? More on that later. And then what's the role of insurance in that situation? And there may be indeed a big role that insurance can play in that situation. What if there's not a death but a disability? Disability insurance? A lot of farmers ignore that. Farming can be rather hazardous. That is also something to consider. Example 5. Complications of divorce. We don't like to talk about this one, but this is something that can severely complicate an estate or business plan. In this situation, we had an operating partnership that had been created by a father and a son-in-law. So dad and his daughter's husband were farming together. Okay, dad views that as a business relationship. Daughter doesn't necessarily view that as a business relationship. Daughter and son-in-law got divorced. Son-in-law is still dad's partner. No longer the daughter's partner, marriage partner, but dad's business partner. See any complications with that? Okay. Probably what we're going to get into here would be long-term leases. Dad, again, is going to take a look at this as a business situation. Daughter's got a different view on this. In order to protect the son-in-law, I think what we did in this situation was we transitioned him to a tenant, got him bought out of the partnership by means of insurance and some other issues, and then he continued on as a tenant under a long-term lease. But that kind of pried him out of that. Fortunately, we had a partnership scenario here which is a much more flexible type of entity than, say, a C corporation. We could get him out without any tax complications and get him into long-term leases of that property, where basically we're still doing the same thing but in a different form. And that satisfied the daughter to the extent that she could be satisfied, and it did throw a big wrench in Dad's estate plan. Okay. Joint arrangements. Now, if you got into this a little bit before lunch, jointly buying machinery and assets, I think the keys to success in joint arrangements is that you can expand your land base by brokering the cost of those purchases over multiple people, obviously. The form to do this in, probably some form of operating partnership or a limited liability company. My personal preference would be a limited liability company. But if you want to maximize payment limits, then we've got to look at a partnership, and it would be a general partnership. Now that runs counter to some other principles, liability issues and the like. But what you get into with FSA is anytime there's a limitation on liability in the entity, that entity is not a separate person from the individual owners of the entity. But if we don't have that, such as a general partnership, then we've got the general partnership that is separate from the partners. So we get more payment limits. That's not the entire game that we play, though, with respect to estate and business plan. That's one piece of the pie, but it is a consideration. And we'll have to see what the new rules are going to be with respect to active participation once those regulations come out, pursuant to the new Farm Bill. Case example 7 was just simply very complex, multiple entity arrangements with leases going all over the place between the entities and between the individual members. And then gifting strategies for multiple heirs in a large entity situation. So your basic entity choices, there's a number of them, all the way from the sole proprietorship to the cooperative. You don't see too many farmers, although they can, operating in the cooperative form of business. But sole proprietorship, the general and limited partnerships, the LLC, the LLP, the S Corp, the C Corp. And in my book on agricultural law, I've got a chapter devoted to these various types of entities, and then a 2-page table that shows you the pros and cons of tax and non-tax for each of those entities. But there are a lot of those. Of course, the sole proprietorship lives and dies within the lifetime of the sole proprietor. General partnerships, you don't have any limitation on liability. You do if you're a limited partner or a limited partnership. LLCs I really like. LLCs, particularly tax reasons as well as non-tax reasons. It's got a lot going for it. That seems to be the entity of choice these days, along with now the S Corporation in light of the new Obamacare taxes. S Corporations, I think, may actually be favored more than LLCs just purely from that tax standpoint. To get around that passive tax. There are things we can do in an S Corp as long as we pay reasonable compensation, which is a huge issue with IRS. Got to pay reasonable compensation, a reasonable salary to the S Corporation owner, or we can really get dinged. And that's a hot button audit issue with IRS. It's reasonable compensation for S Corporation owners. That's a big issue. And it is also in a C Corporation, but it's not paying enough FICA tax in an S Corp, FICA taxable wages in an S Corp, and paying too much in a C Corp so you can gin up additional deductions. It kind of cuts both ways. That is a huge audit issue. I would just tell you, if you have an S Corporation, or if that's going to be part of your plan, you've got to pay a reasonable wage. So what's a reasonable wage for a farmer or a livestock operator in an S Corp? I've been involved in several audits of S corporations over the past few years, and IRS seems to settle in that $45,000 to $60,000 range, and kind of said, okay, that's fine. It's based on how you make that determination is based on what you'd have to pay somebody to do what the S corporation owner is doing. What would you, if something happened to them and you needed to replace them, what would you have to pay somebody to do their job? That's, it's making a bigger analysis, just truncating it, but that's really what it comes down to. And so there's a lot of testimony that you got to enter into, a lot of evidence that you have to show IRS and all of that, but you've got to pay reasonable compensation. There was a case out of Iowa not too long ago, went all the way to the 8th Circuit. They tried to get the U.S. Supreme Court to take it. It was not an ag case, but it's illustrative of the issue here. It was a CPA in Des Moines, West Des Moines. And it was a partnership where each individual partner in the CPA firm had an S corporation. Had their own S corporation. So they paid themselves a salary out of what they generated for the CPA firm. And this guy, who had over 20 years of experience, paid himself $24,000. That was his salary. And he took drawings, withdrawals, basically dividends out of the S corporation of another $200,000 each year. Of course, the $200,000 that he withdrew out in non-salary compensation is not subject to FICA tax. Cool. He's only paying FICA tax on the $24,000. Of course, the wage base at that time was about $90,000, so he's saving the FICA tax, the Medicare tax portion of that, between $24,000 and $90,000. You know, several $1,000s a year. IRS didn't like that, and basically it came down to the fact that IRS was able to establish that, you know, look, brand newly minted CPAs right out of school make more than $24,000. You got 20 years experience, what's your excuse? They said, well, I'm not any good. We don't buy it. So they reclassified. IRS has the power to reclassify some of that $200,000 of dividends that he pulled out as wages. Guess how much they reclassified? Just enough to get him to the FICA wage base. And then they stopped. Yeah. They'll do the same thing in a farming operation. If you're not pulling enough out in reasonable compensation, then you're going to get reclassified. Now, you don't have to go up to the FICA wage base, which last year was $113,700. Next year it's going to be $117,000. You don't have to go there unless the evidence indicates that that's what you're worth. Okay? I have never seen a case where IRS has reclassified beyond the wage base. But these are your basic entity choices, and of course these are the basic issues that will determine the entity choice. We've got tax issues, FICA tax issues, and that's why I kind of toward the S corporation now with this additional Obamacare tax. We've got more ability to eliminate the FICA tax depending on our situation. Fringes are best, however, in a C corp. Liquidation costs are worse, are the worst in a C corp. So you've got a whole bunch of things, and it's not, again, one entity is not always the best or the worst in terms of what you do. I think the greatest flexibility is what you want to look for. A lot of times the LLC is going to give you the greatest flexibility from a planning standpoint. LLC/S corp. Okay. All right. FSA payment limits. These rules have not changed, although under the 2014 Farm Bill, we've got a cap of $125,000 per person. Now, as I read the rules, they didn't change active engagement rules, so I think that still means that spouses can be treated separately, so you can get to $250 for a married couple. Okay? So more than one, sole proprietorship, general partnership. Why is there more than one payment limit there? Why is the general partnership treated as a person separate from the individual partners? Because there's no limitation on liability. Once you have a limitation on liability, you get one payment limit. So that's going to be the C Corp, S Corp, LLC limited partnership. You can't treat the individual owners separate from the entity there because there's a limit on liability at the entity level. I think that rule's the same. They have not changed those rules in the 2014 Farm Bill. Liability of owners, that's always an issue with respect to entity choice. There are ways to limit the liability of the owner based on the entity choice. You can see those choices there.
What's a reasonable rate that a farm manager charges?
Reasonable rate that a farm manager charges? Well, they'll charge based on, their structure can be different. It could be a percentage of the income generated from the farm that they'll take. It could be based on acres. I've seen that.
Percentage-wise?
Percentage-wise, well, that's why it's hard to put a percent on it, because we have to know what they're basing their percentage on. Anywhere from 6 to 12%, anywhere in between. 6 to 12%.
6 to 12, yeah.
Yeah, somewhere in there. I've seen both extremes, depending on what they're doing for you. Okay, that's a broad range that I would give you. Leases also are big. Leases are used heavily in agriculture, and there are implications based on the type of lease that you have. Whether you have to maintain material participation, not for a lot of income tax as well as estate planning tax-related provisions, is big. If you do, then you've got to have crop share and livestock share leases. If that's not an issue, you can go to cash lease, but then you might be generating passive income that would be subject to the additional passive tax, although you're avoiding self-employment tax. But passive leases also may eliminate some estate planning techniques and some liquidity generating techniques after death. So you need to talk with your estate planners in terms of getting the right type of lease, because there are a whole bunch of issues that come up. Post-death. And for farm program benefits, if you're a retired landlord, you have to meet an active engagement test, which again has not changed under the new Farm Bill. And cash rent landlords aren't going to be able to collect any farm program payments. Those are all going to go to the tenant. If it's crop share, you're going to split the payments in accordance with the percentage under the lease. And FSA has its own rules when we get into fancy types of leases, and it's not really a straight cash lease, and it's not really a true crop share lease, so it's kind of a hybrid lease. They've got their own rules that tell us what it is. So you have to be familiar with what those rules are in terms of how you're allocating risk and return under the lease. But active engagement, you've got to be actively engaged in farming to be able to get farm program benefits. Okay? So under the 08 Farm Bill, each person is eligible for a maximum of 40,000 federal farm program payments. There was an exception for CRP. But again, as I mentioned, there's a $125,000 cap under the 2014 Farm Bill. Okay? What you will also find when you do estate planning, business planning, and succession planning, and I'm not digging on FSA, so if there's any FSA people here, I'm not hitting on FSA, but the problem is FSA does not have a real good understanding of LLCs and trusts. They just don't know how to handle them. I have seen more issues with that with lawyers that call and write, and it requires further explanation with the FSA as to how a trust works, how a trust is taxed, whether it's a separate entity from the farmer, what type of trust it is, what's this entity known as a limited liability company. They just have trouble understanding them. There is a disconnect I found on that issue between the local offices, which generally are much better than the national office in DC. I mean, the stuff that comes from DC, the information out to the county offices, sometimes there is a complete disconnect, and I'm sure you're surprised at that. But boy, once you start doing planning for a farmer or a rancher, and you're dealing with farm programs, and now you've created trusts, you've created LLCs, you get all kinds of questions that shouldn't be questions, is what I'm saying. And we have to take an extra step and just explain to them, no, we're not trying to set up some sort of scheme or device to defraud the program. This is a legitimate plan. This trust is the same thing as the individual. It's a grantor trust. And some of you probably have been there and you know exactly what I'm talking about. But that's just another thing you need to be aware of as a potential issue that might come up. Okay, with respect to payment limitations, I think there are 4 key issues in terms of, and these rules stay the same until we get new regs. Who may be a person? A separate person must satisfy separate and distinct requirements. Certain persons can be combined with other persons, and then an eligible person must be actively engaged in farming. Those are your rules to be eligible for a payment limit. Those are the issues that we deal with when we're doing estate planning and succession planning, business planning, to satisfy those tests. Okay, I'm going to skip through the rest of the detail on that and keep you out of the Code of Federal Regulations, because that can get pretty deep. But to be actively engaged in farming, you've got to satisfy that to be eligible for payments, and a person must make significant contributions of capital, land, or equipment, and active personal labor or active personal management. And the contributions must be commensurate and at risk. This requires a great deal of planning for farmers and ranchers to make sure that we maintain that eligibility. I have seen estate plans drafted very, very well by attorneys that were working with farmers that were not familiar with the farm programs, and ended up inadvertently creating a bunch of problems for the farm clients simply because the planners didn't understand farm programs. And there is a small subset of lawyers that actually know this stuff, and those that know it seem to be collected in Arkansas for whatever reason. I think historically in the past, you've heard of the Mississippi Christmas tree. Yeah, those were done by Arkansas lawyers in the past that know the system really well. And there are a couple of firms down there that are really good at this, and if you're getting into big operations where there are multiple payments, you're probably at some point in time going to get referred to one of those firms to make sure it's set up correctly. Because I have seen some really good plans just blow up because nobody factored in FSA. Okay, I'm going to skip the rest of that discussion. Fringe benefits. For farmers and ranchers, the focus on fringes, and again, we're talking, this is kind of what we think, the thought process that we go through, what we think about when we're setting up entities and trying to figure out what the correct entity choice might be. And it's primarily health insurance and retirement plans that we're thinking about. Thanks, Joni. Health insurance is fully deductible for sole proprietors or shareholders of corporations. Okay, fully deductible. It's a deduction against income tax. It's not against FICA tax. So it's on the 1040. It's not on the Schedule F or the C. There was a Kansas case a few years ago that went to the 10th Circuit on Section 105 plans. How many of you have medical reimbursement plans? Okay, or HRAs, health reimbursement arrangements? Okay, talking about the same thing. 105 plans. Okay, Charlottetoe is from the Smith Center area, Smith County, up, what is that, about straight north of here, up on the Nebraska border. And they had a AgriPlan Biz Plan, and some of you may have an AgriPlan Biz Plan. That's one of the companies that administer these 105 plans. So it was a sole proprietorship operation. Dad employed mom in the farming operation, and she's got to be the employee, so there's an employment agreement. And AgriPlan Biz Plans, it gives them all the documents that they have to set up, and it goes through their lawyers and so forth, and then that's good. And the local CPA firm worked with AgriPlan Biz Plan to get this all set up correctly. So mom is employed as dad's employee. When she incurs medical expenses, she turns it in, and dad reimburses her. It's a deductible expense for dad's business, and it's not reported in mom's income. You get a nice deduction for this. Fully deductible, sole proprietor dad, and it's against his income tax, so it's on the 1040. And IRS didn't like this, and they challenged this. Mom's not really his employee. And mom kept a logbook of what she was doing. She was doing this by the book, so to speak, exactly what IRS has said in the past you need to do. Keep a record of what you're doing on a daily basis, following your employment agreement. And IRS challenged this basically on the basis that in a spousal situation where the assets are jointly owned between the spouses, that mom can never be dad's employee. And to employ her just for this purpose is a sham. Well, it's allowed under the Internal Revenue Code, 105 plans, these medical reimbursement plans, that's fine. Well, they go to the tax court, and they lose in the tax court. The tax court, full tax court opinion, agreed with the IRS. Said, yeah, she's not his employee. She has to be his employee to be able to do this, and mom can't be dad's employee. And they brought up, they're spouses, so one spouse can't employ the other spouse. It's just off the wall wrong. Goes to the 10th Circuit, and the 10th Circuit didn't reverse the tax court. They vacated the tax court's opinion. Now, when a higher court vacates a lower court's opinion, that means they take out the eraser and this opinion that was written in chalk. It's not just reversed, which means it would still be there. It's gone. You were so bad, is what they're saying, so ridiculous of an opinion, we're removing it from the record. It doesn't exist. Now that's an important move, because had the 10th Circuit just simply reverse the tax court, then IRS could still use that tax court victory in circuits other than the 10th Circuit. They could go bother people in Iowa in the 8th Circuit or in Nebraska in the 8th Circuit. Now, you'd be okay in the 10th Circuit here in Kansas, but they could still use their opinion that they've now lost in other circuits. And they do that kind of stuff. So the 10th Circuit wiped it off the books. Long story short, this case settled in favor of the IRS did not want to push this on. I actually got a call. I know the CPA firm well. They attend our tax school out in Hayes. And I helped them through this. I got a call one day a couple of years ago. And the lead CPA in that firm said, we just got a call from IRS and they want us to settle the case. What do you think? I said, well, I think they want to settle the case because they don't want to go back to tax court with the order coming from the 10th Circuit to redo this and find that there was a spousal arrangement here, employment arrangement. They didn't want to have that record on the book against them. They don't want that out there, so they want to push this thing under the rug. I wouldn't settle it. I said, what have they offered you? And he said, everything that we initially wanted, that we were doing the first time. He said, they'll just give it to us. And I said, yeah, I bet they would. He did eventually settle the case, favorable to the client, and the 10th Circuit opinion holds and the tax court opinion is gone. 105 plans are really helpful for farmers and ranchers as part of their overall estate plan. Now comes Obamacare, kicking the shins. Pretty much kills off 105 plans. I mean, this is horrible. Notice 2013-54. Is Obamacare the death knell of 105 plans? Pay attention here. Okay? Notice 2013-54, 2D1 of the notice says that market reforms, that's Obamacare, do not apply to a plan that has fewer than 2 participants who are current employees. Meaning the Act is going to leave 105 plans alone if fewer than 2 employees covered by them. Now, get out your calculators or your phones. What's fewer than 2? Good. Well, you're cheating. You're a financial planner. So you know that 1 is less than 2. That's not fair. Okay. What happens if you have 2 or more people covered by a 105 plan? You're now subject to Obamacare. So spousal-only plans are okay. Everything else, not so fast. So the spousal-only plans are exempt from the overall and preventative services no cap rule. See, that's the problem. If you get more than 1 person covered, Obamacare's got these rules in on you can't cap preventative services, overall services. There can be no cap on them, and there are caps under 105 plans because it's just tied to what they incur, and that's what you're reimbursing. What the new law says, okay, you can do that for 1 employee, but more than 1, no, you can't do that anymore. You're subject to these new rules. So a Schedule F proprietor husband employing his spouse would still qualify for a 105 plan, even if the plan allowed the spouse to seek reimbursement for family medical health care expenditures, but you can't go any further than that. Can't cover more than 1. If you do try to cover more than 1, then you're limited to covering only ancillary benefits. What are ancillary benefits? Dental, vision, disability, but that's it. Long-term care, that's it. You can't just do a standard medical reimbursement when you've got more than 1 person covered by the medical reimbursement plan. So 105 plans are still permitted for ancillary benefits only beyond 1 person. So an employer with more than 1 employee can still get pre-tax dollars over to the employees in a manner that is exempt to them for those ancillary costs. But your full-blown 105 plan is gone once you get beyond just 1 covered employee. Now, does that make sense from a healthcare minimization cost standpoint? No, of course not. But again, keep in mind what the purpose of the Act was. Not healthcare. Okay. That's just the vehicle. All right. So the standalone 105 plan for 1 employee would clearly also, the IRS said, if you've got that spouse covered by a 105 plan, that prevents that spouse from accessing the exchange subsidy or the 36B credit. See, they put a carrot out there, and it's a credit to help pay the increased cost of health care as a result of the act. So they put a credit in there, but if you have a 105 plan, the covered individual's not eligible for the credit. Again, what sense does that make? From a healthcare cost minimization standpoint, it doesn't, but that's not the point. So this is another hit on a 105 plan. Yes, you can have one person covered, but if you do, they're not eligible for accessing the exchange subsidy or the 36B credit. The document that you want to look at is IRS Notice 2013-54, where all of this is laid out. And that's available off the IRS website. It's written in a question and answer format. Notice, this is question 10 of the notice, Notice 2013-54. You can just go to irs.gov and type that in the search box, and it'll pull it up, and you can see all of this. Okay? 105 plans have been used heavily in the ag sector. I'm still not sure. I addressed this in last month's newsletter for the center because these companies that do these, they've been hit pretty hard, and I think some of them are just finally coming to a realization of what's happened to them. I started saying this a year ago, and we have one of these companies that's a sponsor of our website. And I had to talk with their president and their CEO and finally convinced him, yeah, you got a problem here. This is going to change your business model. And so now we've seen some other companies try to come up with a different type of plan. And in my newsletter last month, I said, that one's not going to work either, the way I'm looking at it. And we bounced that off some other CPAs and lawyers. And this is really problematic. And this is a problem with the new law. Okay? All right. So large employers that routinely blend a 105 plan with high-end insurance coverage can still use them, but only if they meet all the guidelines in that notice. Small business clients can only use them if there's one employee or it's limited to ancillary benefits such as dental and vision. That's it. So that's one of the fringes that for sole proprietorship farming operations has really been limited and restricted. Okay, liquidation costs. C corporations, as I said earlier, have the highest liquidation costs of any of the possible entity types. You got a lot more flexibility with partnerships and LLCs. Okay, one of the problems that's out there, and if you'd like more information on this, I know somebody's already asked me this today. I won't get into it here, but on the back side, see, back in the 60s and 70s and up to the mid-80s, a lot of people in farming were creating C corporations and putting their land in C corporations. You don't have to admit that you did that. If you did, that might have been a perfectly fine strategy at that point in time. Because of Congress changing the rules and pulling the rug out from underneath us, that has turned out to be an absolutely horrible strategy. Because now we got people that have land trapped in a C corporation that they want to get out of the C corporation, and now they're learning that because of what Congress did in 1986, you're going to get taxed twice. Nice. Yeah, and so we get questioned, okay, how do I pry this stuff out of a C corporation and only get hit once? There are some techniques to go through, and there are some suggestions and things you need to do before you make an S election and convert that C to an S. Basically what you're going to have to do is convert the C corporation to an S by making an election to be treated as an S corporation and wait 10 years before you dispose of the assets, before you get the assets out. Now again, my snippy response to getting around the 10-year requirement is to die, because then it's 10 years or death, whichever comes first. Most people would opt for I'll take the 10 years. But if you've got grain and livestock, how many of you are going to hold grain for 10 years? How many of you are going to hold livestock for 10 years to avoid the tax? One of the things that you need to do is dispose of the grain or the livestock before you make the S election. Or else you got a tremendous, I can show you tax rates that'll be in the 85% range if you hang on to grain and livestock and then make the S election and then dispose of the grain or livestock within the 10-year period, which you will do. It's just going to cascade a whole bunch of tax down on your head. There are techniques that we can suggest. It gets very complex as to how to get that asset extracted out of the C Corp after you make the S election inside that 10-year period. But that's a tough thing to do, and that's unfortunate. The advice might have been sound to create those years ago. It's not now, and we can't. You're not grandfathered in on that. Okay, also another point is, particularly for larger valued estates, if you're up in that $10 million range, do whatever you can to keep the estate qualified, both pre and post death, for special use valuation. This is an estate tax technique that allows you to value land in the estate at its ag value rather than its fair market value. Okay? Normally, property is valued in a decedent's estate at its market value. There's a special rule that's going to allow ag property, farm real estate, to be plugged in the estate tax return at its value for ag purposes, its use value, rather than its fair market value. Now, the maximum reduction you're going to get for deaths this year is $1,090,000 from fair market value. So if fair market value of the land's $5 million, we can potentially value it in the estate for tax purposes, what, at $3,910,000. That'd be our maximum reduction. But we're saving 40% on that $1,090,000. See how that works? We're pulling $1,090,000 out of taxable value. Our tax rate's 40% on the top end, so take 40% of $1,090,000, you get $400,000 times 40% of 90, which is what, another $36,000. So you get $436,000 as your tax savings maximum by making this election. That's big. Those are taxes that don't have to be paid if you make this election. Now, there are a whole bunch of requirements that have to be satisfied before death and after death to qualify for this. And a lot of it's going to turn on the type of lease that was the decedent landlord had before death, and then what the family members do with the farmland for 10 years after death. They have to continue to farm it. It gets incredibly technical, but what I'm saying here is no matter what you do, if you're in that $10 million and up range, do whatever you can, make sure you're familiar with what these rules are, and then do whatever you can to keep the estate qualified, both in the time frame leading up to death as well as for the family for 10 years after death.